Last year, millions of people opened trading apps for the first time. They didn't walk into a casino. They didn't call a broker. They tapped an icon on their phone. And within weeks, most of them lost money. Not because the market crashed, not because they're stupid, but because they were playing a game they didn't understand. Right now, trading is sold as skill, precision, freedom, charts, indicators, smart money concepts. But underneath all of that, it's math, cold math, and most people never run it. Let's slow this down. Imagine you start with 10,000 rupees. You risk 2,000 per trade. You win 3 trades in a row. You feel sharp, in control. Then one bad week hits. 2 losses, then 3. Now you're down 6,000. To recover from a 60% drawdown, you don't need 60% profit. You need 150%. That's the part no one posts on Instagram. Markets don't move in straight lines, but your capital shrinks in straight lines when you're overexposed. Here's how the system actually works. Every trade has 3 invisible costs. First, spread and brokerage. It looks small. It isn't. Over 100 trades, it compounds quietly. Second, slippage. You think you're entering at one price. You don't. Third, psychology. This one is expensive. Because after 2 losses, your brain changes. You increase size to recover faster. You move stop losses. You close winners early. The market doesn't need to beat you. You beat yourself. Now let's talk probability. Most retail traders aim for a 1-to-1 risk-reward ratio. Risk 1,000 to make 1,000. Sounds balanced. But with brokerage, spread, and occasional mistakes, your true reward becomes slightly less than 1,000. Your loss stays full size. So even with a 50% win rate, you slowly bleed. To be profitable long-term, you need either a higher win rate with discipline or a better risk-reward structure with patience. Both are rare. And here's the uncomfortable statistic. In most derivative segments globally, around 80 to 90% of retail traders lose money over time. Not in a day, over time. Why? Because short-term trading is a zero-sum game before costs. After costs, it's negative-sum for the majority. For you to win consistently, someone else must lose consistently. And the someone else is usually not a beginner with a YouTube strategy. It's institutions with faster data, better risk models, and deeper capital. That doesn't mean trading is impossible. It means the marketing version is fiction. You've seen the reels, turned 5,000 into 1 lakh in 3 days. What you don't see is the account that went from 1 lakh to 12,000 the week before. There's a quiet irony here. People spend months researching a 20,000 rupee phone, but will deploy 50,000 into markets after watching 2 strategy videos. Because trading feels intelligent, it feels productive, it feels like you're building something. But frequent trading is often just paying tuition to the market. Let's zoom out.